Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Dr. Derek Hosmeyer, professor at George Mason University. Dr. Hosmeyer is a regular contributor to the Wall Street Journal too. His research focus areas include ETF and mutual fund performance. Dr. Hosmeyer, welcome back on the show.
Thank you, Nina, for having me on.
So I wanted to start with the Fed. Last week, they announced a new policy framework, and this was not in response to the pandemic, but this was following a policy setting strategy review that started in late 2018. So please explain to us why they decided to revamp the framework and how will this new policy framework impact financial markets?
Yeah, very good question to start off on. For the listeners that kind of missed the news, the Fed basically said they are going to let inflation run over the 2% threshold to kind of average it out so that it's in the long run it's about 2%. So this move to allow inflation to run above 2% to make up for times when it was under 2%. Is a very interesting move. The Fed, for most of its history, has been really averse to inflation, letting it run above its long-run target. And so the Fed is basically giving up here and saying, we've tried for years to get it to go up to 2%. Let's let it run hotter than we would normally expect, and let's focus more on unemployment. Let's keep unemployment as low as possible. And so it's a very interesting move, and the people that are going to be hurt by this, I guess you would say, are savers. People that are saving out there, maybe you're in your 50s or your 60s, you're nearing retirement. This move to basically say we're going to let inflation go above the 2% barrier means that interest rates are going to stay at zero for even longer than we thought. So if you had hoped to gain yields by having them in safe assets like bonds, tips, money markets, things like that, you're kind of out of luck now because yields are going to be basically zero for at least the next few years to encourage inflation to tick up.
So lower for longer rates, or we can call it QE forever, it should be good for stocks, right? So does it mean that stocks can continue to go higher?
Yeah, very good question. So this news that the Fed is going to let inflation, go up to 3 or 4% possibly, if they can get it there, is good news if you're a home buyer because you're keeping, rates artificially low. It's good. It's very good if you are kind of on the cusp of unemployment, if you're a low-income individual, because the Fed is signaling they're going to let unemployment go down to zero if they could. There used to be a theory that unemployment should go down to 4%, but that would be about as low as you should let it go. Now they're saying we'll let everybody be employed in the U.S. So if you are on the marginalized side of employment, then this is good news for you. And you're right. If you're a stock investor, this is also good because you're lowering the discount rate. You're lowering the discount rate to, very, very low. I mean, the 3-month is down around, 0.1%. Even the 10-year rate of return is under 1. It's down around 0.7%. You have to go all the way out to the 30-year bond to see any interest rate that's above 1%. So it's a crazy low interest rate world. And what this does is boosts the valuation of stocks and other securities that operate like equity. Another adverse thing I would say it does is it makes junk debt yields go down. So it makes junk debt yields go down, and it pushes investors into riskier parts of the bond market to try and gain yields. So, yes, it's good if you're a stock investor, but please, if you are in your 50s or 60s and you're looking for yields in the debt market, please, be wary if you go into non-investment grade debt. It's always a difficult thing, but you want to search for yields in that market, but junk debt is always a scary thing to go into.
So we'll talk about junk debt and bonds in general in a little bit, but focusing on stocks for the time being, which areas of the stock market can continue to do well? And we know that growth stocks have led their rally so far. In fact, the Russell 1000 growth ETFs are up 30% this year, while the Russell 1000 value ETFs are down over 10%. And this is the widest margin in decades. And in the past, we have seen these mini rotations out of growth into value, which probably lasts for 1 or 2 or 3 days at the most. But investors keep coming back to growth because in this uncertain economic environment, they like companies that can deliver faster profit growth. We have been hearing about value, value will finally get its mojo back for years, but that didn't happen. And you wrote an interesting piece recently, should fundamental investors give up on value stocks? So tell us, should they, or growth stocks can continue to do well?
Yeah, very good. So that was a fun theoretical piece to write about. I wrote it with a few students of mine. We looked at whether it makes sense if you're a fundamental investor and you're researching a stock. What type of stocks could you research to possibly make money? And we show in a high interest rate environment, it makes sense to research value stocks. In high interest rates, if you do good research and you find the correct dividends or the correct cash flows of a value stock, you can make a lot more money than actually investing in a growth stock if you have better information. But in a low interest rate environment like now, it really only makes sense to research and allocate your effort to finding out the true value of growth stocks. And I think that's what we're seeing now. We're seeing everybody out there, the volume of trading on growth stocks has just gone through the roof. Everybody out there is taking up bets on whether Tesla is the next, is going to be the next GM. People are taking bets on whether Zoom is going to be the next form of work for most people. So it was a fun article to write, and it basically shows that, profits to be made by doing fundamental research in growth stocks during this low interest rate environment. To follow up on your question on stocks in this environment, it's really an interesting bifurcated market. And I think a lot of investors see this, where when bad news about the economy comes out, stocks like Zoom continue to do better, Peloton, all of these work from home stocks. And then when good news about the economy comes out, then you see your more traditional reopening stocks do better, stocks that would do better when you have face-to-face meeting, whether it's luxury brands or these other kind of stocks. So it's a really interesting bifurcated market that people are betting on, where is the new economy where we all work online and we don't interact with anyone, is that going to win out, or are we eventually going to go back to normal, where kind of the old guard stocks are going to do better? And there's very few stocks that span both those worlds. I guess maybe like Amazon and Google and Facebook, I guess, kind of span those worlds. But a lot of stocks are in one camp or the other. So it's an interesting time to be an investor.
Sure it is. And it's a very challenging time for bond investors, as you alluded to earlier, because in the low interest rate environment, it's very difficult to find yield. And you suggested that they should avoid avoid going to junk debt in search of yield. So, should investors still have bonds in their portfolio? Are there any areas of the bond market that look attractive to you? For example, municipal debt. Is 60-40 portfolio still relevant?
Yeah, even though yields, with debt, you're down around a 1% yield, even for long dated bonds. But still, it needs to be part of your portfolio no matter what. Maybe you decrease your exposure a little bit, but with stocks, just the S&P and even the Nasdaq, it's even at a more ridiculous level. Their PE ratios of these indices are just through the roof. I mean, whether you look at a Schiller kind of backwards looking PE or a forward looking price over earnings ratio, we're at unprecedented times. This is upwards of it's not quite where 2000 1999 was, but we're historically way up in the the top 3 percentile or so of valuation levels. So with things at this valuation level, you have to have some sort of protection here in your overall portfolio should stocks come back to earth. So I would definitely recommend, maybe not 60-40, but something still in line with, holding your age in bonds, as they say, or something along those levels. I would not remove bonds entirely from your portfolio. If you are scared about the yields with bonds, you can always invest in, as you said, municipal debt or TIPS or other forms of not just U.S. Treasuries, but other forms of debt that are still yielding a little bit. And with TIPS, you get a little protection against inflation.
Could you talk a little bit more about municipal debt? Because that is an area, investors do not understand properly, most of the investors. Do you recommend looking at individual municipal bonds, or do you think a municipal bond ETF or a mutual fund is better for investors?
Yeah, I think for the average Joe out there, the average person who wants exposure to muni bonds, again, you don't hold them. If you do hold them, please don't hold them in your 401k because you don't get really the tax benefits from that. So I would, the average Joe, I think, would be better equipped to buy a muni ETF or a muni mutual fund in their particular state. There's most states, most populous states, I would say, the top 15 populated states in the U.S. all have muni mutual funds. So if you are in one of those states, please do consider that. These are states like New York, New Jersey, California, Texas, Florida, et cetera, all have municipal mutual funds, which makes it very easy to invest in at low cost. You get tax sheltered from state and local income taxes and federal, and they're cheap. The expense ratios on these, if you turn to like Vanguard's products or others, are pretty low. So I would go with that route.
That's very helpful. Thank you. Now let's talk about inflation a little bit. We have seen this massive fiscal and monetary stimulus in the wake of this coronavirus crisis. And in view of the new policy framework, the new monetary policy framework, some investors are worried about a surge in inflation. So should they worry about a surge in inflation? Is that a possibility in the coming years? And how can they prepare for an increase in inflation? And I saw that you recently wrote an interesting piece for the Wall Street Journal, about hedging against inflation. So talk about that, please.
Sure, of course. Yeah, it's amazing how much the Federal Reserve can pump into the economy in terms of liquidity, and we still don't see inflation move much. we're up to, 7 trillion on the balance sheet of the Federal Reserve, and a $2 or $3 trillion increase in their balance sheet just in the last 4 months, which you think would have a big shock to inflation. But we haven't seen it yet. You can always speculate whether that's coming down the road, but it's just amazing how much liquidity they can add to the system and how much money they can create. And because it doesn't get circulated as much as people would think, we're not seeing, inflation tick up. So, yeah, it's a very interesting puzzle. And we have seen in times of really bad inflation, the best way you can hedge against this inflation, if we go back to the 1970s and 80s, would be to invest in things like silver, gold, oil, really hard commodities. We find that stocks and bonds do absolutely terrible when inflation ticks up. So these are important things to have in your portfolio, whether it's directly holding them or if you're holding mining companies or oil and gas companies in the forms of stocks or their bonds. That's another way to partially hedge against it. But really, you need some exposure to raw materials, mining, oil and gas, and minerals like copper, silver, gold. At least part of your portfolio should be in this if you are concerned about inflation.
Yeah, gold is definitely a very interesting recommendation, and I usually, recommend to our clients, our listeners, that gold deserves a small place in the portfolio, about 5%, just because it is negatively or it has no low correlations with other asset classes. And for investors who are looking for gold ETFs for long-term holding, then GLDM, which is Spider Gold Mini Shares, and BAR, which is Granite Shares Gold Trust. These are two cheapest physically backed gold ETFs with a lot of liquidity. But as far as oil is concerned, oil companies and oil, the outlook seems so negative. And even if we get a vaccine, say, in the coming months, some of the trends which have been driven by coronavirus, they may become permanent. We may not see a lot of people flying, especially business travel may not come back. Many people will be working from home permanently, so we may not see a lot of driving. So do you think that investors should still hold oil-related stocks in their portfolios?
Yeah, it's all really good points. People are flying less. As you say, people are not driving as much. You continue to have Russia and Saudi Arabia have skirmishes every few months. So yes, it is a big exposure. I would still have some of those companies in your portfolio. It may have to just be a minor part. And I would add to that, ESG is a big trend where people are pouring more and more money into sustainable energy companies. So
Right.
the traditional old guard, yeah, it should be a small portion of your portfolio. We've obviously seen its percent in the S&P 500 has just really fallen over the last few years. So I would have it on par with the percentage weighting in the S&P 500. That's just what I would do.
What do you think of TIPS and TIP ETFs or mutual funds?
TIPS have seen a pretty big surge in the last 3 to 4 months. We've seen TIPS and TIP mutual funds go up have about 4 or 5% return just in the past few months, which is a big move for TIPS and for bonds, especially kind of usually short dated bonds. So TIPS, I think, again, an appropriate part of your portfolio. One downside of TIPS is we don't know entirely how well they do during times of really mass inflation periods, just because they are a newer product. So we haven't seen how TIPS do kind of over really bad inflation periods over the like in the 1970s, but it should definitely be a part of your portfolio to protect against possible inflation, because the Fed is signaling that they are willing to let inflation run way above its 2% target, maybe even go up to 4 or 5%. So definitely should be part of your portfolio and your bond holdings. Some people have it as 10% of their bond holdings. Some people even have it as much as 40% of their bond holdings. So whatever you're comfortable with is up to you. Yeah.
And just for the benefit of listeners who are looking for a tip, ETF, iShares TIP ETF, ticker symbol TIP, TIP, very easy to remember, is worth a look. Now, I wanted to talk about possible volatility, stock market volatility in the coming weeks. We are just weeks away from the presidential election, and markets are likely to get a lot more volatile. And particularly if we have a disputed presidential election, the chances of which, that's possible. It cannot be ruled out. So how can investors prepare for this upcoming market volatility? And I saw a piece you wrote for the Wall Street Journal recently about stocks and ETFs and smart beta ETFs that can help when the market suddenly plunges. So please talk about that.
So you're exactly right. There is, with markets at these valuation levels, which are, in the top 4 or 3 percentile that we've seen over the past, 100 years, and with the possibility that, we may not know the election results on the election night. That seems like that is a real possibility. And you may not have, candidates concede. That level of uncertainty would cause markets to crash, and it could crash hard. So we found in the past, with large market crashes, the best factors to tilt your portfolio to are low volatility, not surprisingly, and quality. So for the listeners out there, when I talk about a factor, typical factors that we know lead to long run returns based on huge amounts of data would be things like low volatility, quality, small cap stocks over the long run do better, even though these last few years have been very different. And value has done better over the long run, even though these past few years, again, have been very different. So when we look at factors, the best factors that insulate you against crash risk are low volatility stocks and quality stocks, where quality stocks are those that have good and positive earnings. So increasing earnings and positive earnings. So these are kind of avoiding companies that probably like Pinterest and Snap and other companies that are losing money but still seem to go up in valuation. And so we found that these kind of factors do really well when markets plunge. So yeah, I would recommend ahead of the election that people pay attention to these factors. There's lots of ETFs out there that focus on quality, the quality factor and low volatility factor. So if you are at all scared about a crash, then these are good ways to protect yourself. In equities, I should say. You're still going to lose money if there's a crash, but these will go down less than probably the Dow and the S&P in total.
Very interesting. So for investors who are looking for quality ETFs, there are two popular products, one by iShares, USMV, and there's one by Invesco, SPLV. And to learn more about these quality, low volatility, or other ETFs that we discussed today, please visit the ETF section of Zacks.com. Dr. Hosmeyer, do you have any other recommendation for our listeners for investing in these uncertain times?
Thank you, Nina. This was a great discussion. I always love these talks. My last little bit of advice for everybody out there would be to say, try and stay the course. I think, as we alluded to in our discussion, it may be a volatile September, October, and leading into November, given so much political uncertainty and high valuation levels, and with the Fed doing everything they can to increase liquidity in our markets, it's going to be it could be a rocky ride. So, for investors out there, worrying, don't completely sell out of your portfolio of stocks should it get rocky. The number one way people lose money over the long run is by trying to market time. So if you are worried about downside risk, please do shift over your portfolio in terms of equities to things like quality before the election comes up, and be prepared for kind of a rocky ride, but don't completely change your portfolio allocation over these coming 4 months. But yes, thank you, Nina. It was a great discussion.
That's very helpful. Thanks again for joining us today. Thanks for listening. If you want to learn more about Dr. Hosmeyer's research or read the articles that we discussed today, you can visit derekhosmeyer.com. Make sure to be on the lookout for next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.